Markets haven't exactly been a picnic lately, have they? It feels like every time you turn on the financial news, there's another analyst predicting doom and gloom.
Yeah, there's definitely been a chill in the air, hasn't there?
I
All this talk about a potential recession, understandably, a lot of folks are feeling a bit jittery.
Absolutely, especially those who maybe aren't quite as comfortable with the ups and downs of the market. But for those of us who are in it for the long haul, these kinds of market shifts, well, they can actually present some really intriguing opportunities.
That's a really key point, I think. When the market takes a breather, it gives us a chance to snap up shares of solid companies at prices that might be more, shall we say, palatable.
Exactly. And that's where dividend-paying stocks can become particularly appealing, right?
Right. Because think about it. When a stock's price drops, but the company keeps paying the same dividend, that yield, the annual dividend as a percentage of the share price, that goes up.
So you're essentially getting more bang for your buck, more income for the same investment, assuming, of course, the company can maintain that dividend.
Absolutely. And that's really what we're honing in on today.
Yeah, our mission today is to dig deep into two high-yield dividend stocks that our research suggests could be especially savvy buys in this current economic climate.
We've been poring over the data, and we've identified two companies that we think have some really compelling stories to tell, especially for investors who are focused on generating income.
Okay, so let's get right to it.
Let's do it.
Our first company is Energy Transfer. Now, when you hear Energy Transfer, you might think, oh, okay, a utility company, pretty straightforward.
Right, like the electric company or something.
Exactly, and in a way, you're right. I mean, they provide an essential service, right? But Energy Transfer is actually a massive player in a sector known as midstream energy.
Okay, so maybe a quick explainer here might be helpful. Think of the energy industry as having three main parts, kind of like a three-act play. You've got upstream, which is all about exploration and production, finding and extracting oil and natural gas. Then there's downstream, which focuses on refining that crude oil, turning it into the gasoline we put in our cars, and then selling it to us consumers.
Right, so Energy Transfer is in the middle.
Exactly. They're the crucial link, the bridge between upstream and downstream, and they handle the transportation and storage of those raw energy materials. And I'm not exaggerating when I say they have a truly vast network. We're talking over 130,000 miles of pipelines crisscrossing the United States. These pipelines are like the arteries of our energy system, moving natural gas and crude oil all over the country.
It's not just pipelines, though, is it?
Oh no, not even close. Beyond those pipelines, Energy Transfer has invested heavily in storage facilities, processing plants that refine raw energy, and even export terminals that ship energy products overseas. They are a seriously big deal in the energy world.
So they really are vital to keeping the lights on and the economy humming.
Absolutely. They're integral to the entire energy supply chain.
Now, here's where things get really interesting, especially when we consider some potential shifts on the policy front. Our sources indicate that Energy Transfer could actually benefit from some possible changes in environmental regulations and the permitting process for energy projects.
Oh yeah, this is potentially huge for them.
Can you elaborate on that a bit?
So the key factor here is the potential impact of G-regulation, which is something that has been, well, let's just say it's been a topic of much discussion and debate, especially under the Trump administration. The basic idea is to potentially roll back certain environmental regulations and make it faster and easier to get new energy infrastructure projects approved.
And the argument is that this would help boost domestic energy production.
Exactly. The goal is to create a more abundant and affordable energy supply here in the U.S. So if it becomes easier and quicker to get these critical energy projects up and running, well, that would naturally benefit companies like Energy Transfer, whose bread and butter is, developing and operating energy infrastructure.
So less red tape, more pipelines. Got it. Now, for our listeners who are thinking about investing, how does Energy Transfer actually deliver its profits back to shareholders?
Well, Energy Transfer is structured as what's called a Master Limited Partnership, or MLP for short.
MLP.
Right. And MLPs are designed to distribute a large chunk of their cash flow directly to investors. It's a business model that's really geared towards generating that sweet, sweet passive income.
And that brings us to the part that many investors are most interested in.
The dividends.
Exactly, the dividends. So what kind of yield are we looking at with Energy Transfer right now?
As of today, Energy Transfer's dividend yield is hovering around a very attractive 7%. That's a pretty significant income stream for investors to consider.
7%. That's nothing to sneeze at. And what about the potential for that income to grow? Our sources mention that Energy Transfer anticipates annual growth in its cash payout, possibly even as high as 5%. What's fueling that optimism?
Well, there are a couple of key factors at play here. One that really jumps out is the explosive growth of AI, artificial intelligence.
Oh, interesting. AI, how does that tie into energy?
Well, those massive data centers that power AI, they're incredibly energy hungry.
Yeah.
Think of it as AI having an insatiable thirst for electricity. So naturally, reliable and cost-effective energy sources become absolutely essential. And guess who plays a key role in providing that energy infrastructure?
Energy Transfer.
Bingo. So the more AI grows, the more demand there is for energy, and that translates into more business for Energy Transfer, which could, in turn, lead to higher dividends for investors.
Okay, so the rise of the machines is good for Energy Transfer investors. That's a fascinating connection. All right, let's shift gears now and talk about our second high-yield pick, Realty Income. Now, as the name suggests, this one's all about real estate.
Yep. Realty Income offers investors a really intriguing way to tap into the income-generating power of real estate without the usual hassles of being a landlord.
Yeah.
Dealing with tenants, repairs, all that jazz.
Right, so no late-night calls about leaky faucets.
Exactly.
Yeah.
They operate as what's called a real estate investment trust, or a REIT.
And our research actually calls Realty Income the best REIT in the business. That's a pretty bold statement.
Well, they don't mess around.
Yeah.
What sets them apart is their incredible diversification and their very strategic approach to investing.
Okay, tell me more about that.
Well, first off, they have a massive portfolio of over 15,000 commercial properties leased to a diverse range of tenants, over 1,500 different clients across 89 industries. So we're not talking about just a handful of office buildings in one city. This is real estate on a grand scale.
So they're not putting all their eggs in one basket.
Nope, they're spreading the risk. And even more importantly, they've carefully chosen tenants who are less likely to be affected by economic downturns. Over 90% of their rent comes from businesses that have historically proven to be quite resilient.
And these businesses are also largely insulated from competition from, say, online retailers, right?
Right. They focus on businesses with physical locations that people still need or want to visit in person, even in the age of Amazon.
Can you give us some examples of the types of businesses that make up their tenant base?
Sure. Think essential retailers like grocery stores and drugstores, discount stores that offer value-conscious shoppers, and various service-oriented businesses. Their top tenants include names you definitely recognize, like Walgreens, Walmart, and Home Depot. These are companies with deep roots and a long track record of stability.
And their occupancy rates really highlight the consistent demand for their properties, don't they?
Oh, absolutely. Realty Income has consistently maintained a super high occupancy rate, 96% or above, for over 3 decades. And just last year, in 2024, their occupancy stood at a whopping 98.7%. That's incredible.
Wow, so almost all the properties are filled. That's impressive. Okay, now let's talk dividends, because that's what really sets REITs apart.
You got it. And Realty Income has an absolutely stellar dividend history. We're talking 657 consecutive monthly dividend payments since way back in 1969. That's over 50 years of uninterrupted dividends.
Talk about consistency.
And it gets even better. They've also increased their dividend payout for 110 straight quarters.
Wow, that's like almost 30 years of consistent dividend growth.
That's really remarkable.
So as a REIT, they're actually required to distribute most of their profits as dividends, right?
To qualify as a REIT, they had to distribute at least 90% of their taxable income to shareholders in the form of dividends. So by design, they're a vehicle for channeling rental income directly into investors' pockets.
Love that. So what kind of dividend yield can investors expect from Realty Income right now?
Currently, their forward dividend yield is sitting pretty at around 5.8%.
Okay, so slightly lower than Energy Transfer's 7%.
Yeah, but still a really solid income stream, especially when you factor in their incredible track record of stability and consistent dividend growth.
Now, our research also touched on a broader economic factor that could potentially benefit Realty Income. The possibility of lower U.S. Treasury yields, possibly as a result of policies under a Trump administration. How would that play out for them?
Well, that gets into the fascinating world of how different parts of the financial system are interconnected. You see, lower Treasury yields usually lead to lower interest rates overall. And for a company like Realty Income, which uses debt financing to acquire new properties, lower interest rates mean cheaper debt. That translates to higher potential returns on their investments.
So if Realty Income is more profitable, they could potentially pay out even bigger dividends.
Exactly. It's a win-win for investors.
So to recap, we have two companies here, both operating in very different sectors, but both offering some really compelling high-yield dividend opportunities.
Yeah, it's a nice contrast, right?
Absolutely. We have Energy Transfer poised to potentially benefit from increased energy demand driven by AI and the possibility of looser regulations.
And then there's Realty Income, a rock-solid REIT with a long and incredibly consistent track record of rewarding investors with dividends.
And neither of these are speculative, high-growth tech stocks. They're established businesses with tangible assets, pipelines, properties, real stuff, and they have proven resilient business models.
Right. And in a market where growth stocks are facing a lot of uncertainty, those characteristics can be really appealing.
Especially for those who are seeking a steady stream of passive income.
Absolutely.
So for our listeners out there, as you navigate this current market environment, it might be worth giving some serious thought to the role that dividend-paying stocks could play in your investment strategy.
I mean, it's something to consider, right?
Yeah, how might a consistent stream of passive income help you achieve your financial goals? How might it affect your overall risk tolerance?
Good questions to ask yourself.
Definitely. Because exploring how these types of investments might help you weather market storms and build wealth over the long term, well, that's always time well spent.
Couldn't agree more.